How is everyone doing today? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. I found a great article in Bank Director that really focused on what happens when banks made flawed capital decisions. And they offer basically 4 principles that all basically bank executives should be thinking about or considering when making capital decisions for the bank. So let's take a look at this article here. Let's jump into this. So this is called The Cost of Flawed Capital Decisions. Executives must challenge outdated metrics, examine decision alternatives, and ensure capital decisions are based on reality and not tradition. So, and this article starts off by saying, for decades, banks have made capital allocation, capital stack decisions based on flawed metrics, leading to billions in lost shareholder value. Many executives are unknowingly unable to effectively evaluate decisions. Blind spots lead to suboptimal performance and, in some cases, significant destruction of shareholder value. To illustrate the problem, let's focus on mergers and acquisitions. When evaluating transactions, 3 metrics dominate discussions. So, and again, this is kind of classic finance for anybody out there. So you have internal rate of return, also known as IRR, tangible book value, TBV, earn back, and then you have earnings per share, EPS accretion. These metrics aim to answer key questions. Will this transaction create shareholder value? By how much and over what time frame? What alternatives exist and how do they compare? While each metric offers insight, none provide a complete picture. This is very true. I could go through, I could do whole episodes on just examining each one of those, and maybe I'll do that with time. But for the purposes of this episode, we're just going to continue on with it. But I just want for people who are unaware, I just want you to know that these are some of kind of the classic metrics, calculations, formulas, if we will, in finance that you use in banking to basically evaluate a merger opportunity. How quickly is it? How quickly can we see a return? What is that return going to look like? What kind of alternatives? How do we compare these? So these are some of the different things that you use to look at that. So, but anyway, I digress. Continuing on here. So, capital allocation principles. Now it says all executives should embrace 4 foundational principles when allocating capital. Number 1, consider multiple possible future scenarios over a reasonable time horizon. Number 2, measure all cash flows associated with the decision, not just short-term cash flow. Ask, compared to what, to appropriately evaluate alternative uses of capital. And then number 4, look back later to measure outcomes relative to expectations. So in other words, so the first thing is, consider possible future scenarios over a reasonable time horizon. So, well, one of the things to think about, in recent years, we've all seen how the merger and acquisition process has taken much longer than we thought it would. Like, say, a normal transaction takes 12 to 18 months to complete. We have seen things going for 2 years, 2.5 years, maybe even 3 years hanging out there. So definitely. So again, considering multiple possible future scenarios, that's a big thing. Number 2, measure all cash flows associated with the decision, not just short-term cash flow. So again, something to think about there. Ask, compared to what? What are we comparing this transaction to? To appropriately evaluate alternative use of capital. And then finally, after it's all said and done, you should do a look back later to measure what are the outcomes relative to the expectations. So then it says, basically, let's put M&A key metrics to the test against these 4 timeless principles. So IRR counts all the cash flow, measuring earnings to a horizon date and assigning a multiple to calculate the value of earnings beyond that horizon. Because it considers all cash flow, it supports compared to what questions among alternatives. It also facilitates an objective look back. However, as used in bank M&A, it is usually limited to considering a single scenario. Consider this. Will earnings be the same if rates move up or down 200 basis points as if rates stay unchanged? Would pro forma TVB per share be affected by different earnings outcomes? Certainly it will be, as well as by shifting marks on assets and liabilities. IRR, as used in bank M&A, is straightforward but potentially dangerous. EPS accretion also has flaws. It's not calculated across multiple rate scenarios and doesn't count all cash flows, ignoring the value of EPS beyond a horizon, making it insufficient to compare alternatives with different cash flow timelines. TVB earnback also does not stand up to the foundational principles. TVB earnback offers no consideration to potentially wide-ranging earnings per share accretion outcomes in different future rate scenarios. Additionally, all cash flow is not counted. Earnings are ignored beyond the crossover point. And then it goes into talking about a widespread, costly problem. So flaws in decision-making processes may seem theoretical, but suboptimal performance in an environment absent a credit cycle is painfully real. So between January 1st, 2018 and January 1st, 2025, the average bank in the KRX index grew assets by 95%, yet share prices appreciated just 8.25%, an anemic 1.2% annualized return. Among smaller public banks, 1 billion to 10 billion in asset size, the median bank delivered a 1.6% cumulative per share value growth over the same period, according to data from Bloomberg and S&P Capital. These issues are widespread, although not universal. Banks that embrace these four discipline principles have bucked that trend. So recent capital decisions. So this problem extends well beyond M&A decisions. Think of capital decisions over the past 7 years or strategic plans for 2025. How many were examined against the four foundational principles? The second half of 2024 and the first quarter of 2025 saw public banks raising significant equity capital, often for securities restructures. Was this the best use of that capital? Applying the fundamental principles would have provided clarity. And if a securities restructure was in fact the best use of capital, was equity the optimal form of capital? So executives must challenge outdated metrics, examine decision alternatives, and ensure capital decisions are based on reality, not on tradition. So, I think this was a really good article. I like the fact that it considers capital decision making. What kind of capital are we bringing in? When are we using it? How are we using it? These are monumental things to consider when running and operating a bank. And things were very steady for a long time. After the Great Recession, the Federal Reserve kept rates at zero. There was quantitative easing like crazy, and things went like that for a good thing. And I mean, aside from obviously COVID, everything going in there, but for a long time, banks, in a very real sense, were kind of on cruise control. Banks have this thing called Asset and Liability Committee, and that's where you basically measure the shocks of interest rates, change in interest rate policies, interest rate risk, credit risk, how could things change on us? That's what you're trying to figure out. And for a long time, nothing really changed. And then all of a sudden here, though, in these last 3 years, things have been dramatically different. Fed, dramatically increased rates. We've seen, major changes in government, regimes, government policies, things that are going on, regulatory policies and regimes are changing hands here. So a lot of crazy things are happening, which means that all of a sudden that Asset and Liability Committee has become much more lively. I'm sure there have been some great discussions going on there, and figuring out how you're going to allocate capital and what you're going to do with it is critically important. Are we going to invest in an M&A? Do we need to restructure our securities portfolio? So how are we doing this? What are the metrics that we're using to allocate this? And are we considering these four principles here that the authors of this article espouse? Are we taking all these different scenarios into consideration when going down this road? So great things to think about. I could talk about this stuff all day long. I find this stuff to be some of the most fascinating things to think about in banking. And I will say this. Hindsight is always 2020. We can always look back on a lot of different decisions that have been made at banks over the years. Some hurt the bank, some catastrophic. But again, it's easy to play Monday morning quarterback. It's always easy to look back after something's over and basically say, geez, we shouldn't have done that, or we should have done this, or we should have done that. I think it's very difficult sometimes in the moment to make the right calls, the right decisions, in the heat of the moment when the pressure's on, things have to be done. Again, it gets very complicated real quick, I guess is what I'm trying to say. So, but again, great article, fantastic things to think about. I will definitely delve into these issues as in future episodes. No doubt, I would love to do a deeper dive on some of the bank metrics and some of these different formulas and different things that banks look at for all different kinds of things. Obviously, looking more into capital, studying capital. What are the different types of capital? How do banks invest capital? I think those are all great topics for different episodes in the future. So undoubtedly we'll bring more of that to everybody. But with that being said, if you like this episode, please make sure to like, share, and subscribe, as that really helps the channel. Remember to please leave your comments down below, as I always love getting back to everybody. We are on YouTube, Rumble, and all major podcast platforms. And please be sure to go check out some of the episodes up on the channel. I hope everyone has an awesome day out there, and I will see everyone again real soon. Thanks a lot.